You want an economy that's dynamic, that's moving, where money is moving and flowing. That's the best economy for everybody, because lots of people have a chance to get a piece of all that money when it's flowing. But when it becomes stagnant, it's definitely not good. It's my pleasure to welcome a returning guest back to the show, and that is Julio Gonzalez with Engineered Tax Services. And today we are going to talk about the two candidates in the presidential election and what is the difference between their idea of tax plans, how does it affect real estate investors, and most of all, the 1031 tax deferred exchange, which, you've heard me say many times, income property is the most tax favored asset class in America. But would that change with a Biden presidency? And I'm going to answer the question for you in advance. Yes, it would. It might not be so tax favored. So let's dive in. Julio, welcome back. How are you?
I'm good. Thanks for having me back. Appreciate all you do.
Yeah, it's good to have you. So the two candidates, I mean, they're really polar opposites in their idea of tax plans, aren't they?
Complete polar opposites. One would, Biden obviously would like to just get rid of the whole tax reform we did in 2017, bring the tax rates way back up, bring capital gains up to the income tax rates. Like you said, 1031, eliminate 1031. And, coming out of a pandemic, and then putting that tax burden on small businesses and individuals and creating a 1031 program that eliminates really the exchange of capital for real estate. I don't think that's the thing we want to do right out of a pandemic.
Yeah. Well, I agree with you. And, most of these left-wing tax policies and social policies, it seems, the thing people have to understand is that taxation is not a zero-sum game. When you increase tax rates, you suppress economic activity. And if you tell investors, for example, that, look, they can't exchange properties tax-free like they have been for decades and decades. They can't do that anymore. If they sell a property they have, they've got to pay tax on it before they buy another property. Well, first off, they may not sell the property in the first place. They might just keep it, and that'll make the market more stagnant. It'll reduce the business for real estate brokers, mortgage people, escrow companies, title companies, settlement attorneys, transactional attorneys, accountants, your profession. So all of that business would just evaporate. It wouldn't happen if a transaction doesn't happen, right? But also, you create a situation where there's less velocity of money, right? And then after all of that, there would be no incentive to buy a new property. There would just be an incentive to sell the property. Well, there's no incentive to sell it, but if they did sell it, they would just sell it, and who knows what they would do with the money? Maybe nothing at all. Maybe, just let it sit. And so then you get into the issue of, well, there'd be less rental housing available if investors aren't buying as much rental housing because some of that incentive goes away. So that would put upward pressure on rents. Now, you would think that the Democrats would want to help renters who are usually less wealthy than owners, right? But these have all sorts of either unintended consequences, but I really think many of them are intended, actually. So your thoughts? A lot to chew on there.
Well, and I think about the banks too, right, that are holding the mortgages and want to get these banks back into the exchange, and no capital now coming in, right, because people aren't going to sell their buildings if they don't have that tax deferral, that 1031 exchange. And so how are we going to buy these assets held by the banks now that are in basically a foreclosure? And so what happens to the banks, right? I mean, how do they get rid of this inventory when there's no cash flow coming in? And
Yeah.
then do we start the whole 80s again where we have the banks closing, the S&L crisis? And what does that do for the real estate industry?
That's a great point that you make. So that's a knock-on effect, right? And so if there is a foreclosure crisis, which I think is an if, depending on the bailouts and the interest rates and so forth, but there's certainly going to be some increase. I mean, I don't think anybody would deny that. I certainly wouldn't. But it may not be that extreme, but regardless of the magnitude of it, you're disincentivizing investors to purchase those properties from banks, which means the banks would be keeping the properties on their books longer, and that would hurt the liquidity of the banks. And then you possibly have this domino effect of a banking crisis, right?
I'm concerned about that. And I think, too, what I'm hearing is that the banks are getting a little tighter on credit. So, again, if you don't have that cash and liquidity coming into the market to help stimulate this, and like you said, it's not a zero-sum game because of real estate's being purchased, even though it's coming in with 1031 deferral money. There's sales tax, right? There's property tax.
Right.
There's all sorts of tax being generated as the money flows through the system. And what about the jobs that are going to be eliminated, like you discussed?
Mm-hmm. Yeah, good point. Take us through some of the other highlights or things that concern you about tax plans on both sides. And if you could give us something to compare the two candidates, that'd be great.
Well, I think I'm very concerned because obviously in Biden's plan, he wants to eliminate the tax reform. They basically want to set that aside and reverse it. Now, when we did the tax reform, we brought the corporate tax rates down to 21%. We did a modest lower income tax rate for individuals. And basically, they want to take those back up to the all-time highest and use that taxable income money to go into social programs. But look, like you said, even though it's not 1031s, but income tax rates, it's not a zero-sum game. So we're going to be paying more income tax rates as small business owners, but we have choices as small business owners, right? I mean, and so do the corporations, the C corporations, the public companies. They weren't here before tax reform because we had not a tax rate that was competitive. We didn't have regulations that were competitive. And we saw businesses come back. We saw unemployment go to its all-time lowest, the stock market at its all-time highest. And what did that mean? With lower income tax rates, more money was going to the IRS, more money was going to the Treasury because more people were working, businesses were coming back. Yeah. And we had a better partnership. And now we want to reverse all that coming out of the pandemic. We want to take it out to the all-time high. I don't know how that works.
Yeah, I would agree with you. And that's what people just really fail to realize. If you don't know about this phenomenon, do some research on it. There's a great video on YouTube I recently watched. I think it's Liberty University or something like that. And the professor just explains that, when the government raises tax rates, they end up netting a certain amount. And when they reduce tax rates, they end up netting a certain amount. And it's oddly, eerily about the same. But what that doesn't tell you is that the future, right? They're talking about in the comparing the current year when they do that. And what they don't tell you is that the future is that it just leads to a smaller economy, a smaller marketplace, less velocity of money. And when money becomes stagnant and doesn't have velocity, that really hurts an economy. You want an economy that's dynamic, that's moving, where money is moving and flowing. That's the best economy for everybody because lots of people have a chance to get a piece of all that money when it's flowing. But when it becomes stagnant, it's definitely not good. So what about the Biden $15,000 tax credit for, I believe, for first-time home buyers? That seems like it would stimulate the market, right?
Yeah, I think so. And I mean, I think that, the Trump administration they want to do some similar programs. They want to lower the income tax rates for the individuals, which will also help and have some more favorable financing through the government agencies. So I think there's no doubt that either one of those programs will help first-time home buyers, and I think certainly those are good things.
Yeah, yeah. What else do you want us to know, Julio? Just any questions I haven't asked you or anything you want the listeners and viewers to know?
Sure. Well, under the Biden program, not only the income tax rates would be increased, but capital gains rates would approach the income tax levels. So again, here, like with 1031s, that would stagnate this market where capital gains rates go to an all-time high, and now people are holding on to their stocks, holding on to their bonds, and, you know, again, stagnating that whole flow of money.
Yeah, so you raise capital gains and people just sit and they don't do anything, right?
That's right.
Yeah, very interesting. Now, does Trump want to completely eliminate capital gains tax? I think he does, right?
Yeah, I think he wants to eliminate it, especially because of the pandemic, to get the economy going, get the velocity going, and get people the ability to stimulate the economy in a way that really is proactive. And I think that would really help. Like you said, I mean, ultimately, that collections to the IRS and Treasury seems to be about the same. Right. But do you want it through a velocity type of economy, or do you want a stagnant economy?
Yeah, good question. And you definitely want the economy with the velocity, because what that example I gave earlier with I believe it's the Liberty University video, is that, you know, it doesn't tell you about what happens the following year and the year after that and the year after that. And for sure, when you have more velocity, the future is better. There's just no question about that. It only tells you that in the current year, you know, that tax rate change up or down leaves the revenue about the same for the IRS, right? But what it, you know, in future years, it makes the economy larger. I mean, people think about it. This is just common sense, right? If you had zero capital gains tax, there would be a lot more trading. People don't trade when they're going to get a tax. If you want to incentivize something, then stop taxing it. You know?
That's right.
You know, if you tax it, you're going to disincentivize it. This is obvious. I mean, a kindergartner can figure this out.
I think you're right, and thank goodness you're putting this out there, because you would think the media would think that the only way to recover is by increasing the tax rates and making people pay. But remember, when we had the high tax rates, the businesses weren't here, and the businesses have options. And whether it's high state taxes and people leave New York and California to go to Texas and Florida, or whether it's corporate tax rates for countries, right? We saw our big companies, right? They went to Ireland, they went to Canada, they went to Australia, they went anywhere else that the tax rate was more favorable.
Absolutely. The people and companies vote with their feet. And, you know, this has been playing out for years. We've reported on it many times over the years of people leaving high income tax states like the Socialist Republic of California or the Socialist Republic of New York, and moving to business-friendly places like where we live in Florida, right? You're not too far from where I am.
That's right.
Yeah.
I just want to address one concern real quick, and that's, you know, California proposing the wealth tax, right? The first in our country, and that the Biden plan and the Biden team are really getting behind this in California, where they're proposing a wealth tax, wherever your wealth is, wherever it is in the world, that you would pay a percentage of that. And when the governor of California was asked why they would do this, you know, because they have a big deficit, because they keep encouraging everyone to leave, he said, we're going to do this because we can, because it's California, right? But you're saying, people vote and they leave. And I'm afraid that, you know, that picking up speed with the Liberal Party, we'll see that with other states. And then ultimately, they'll try to put that right into our federal tax code system.
Yeah, California has got four tax proposals on the table now that are extremely scary. One of them, of course, is the wealth tax that you mentioned. But what they're basically doing is something, Julio, that I predicted over 10 years ago, that California would build an economic Berlin Wall to try and, look, the Berlin Wall was built around East Germany to prevent the brain drain. And they put it up in a weekend and made everybody a prisoner because everybody was just leaving for the West, right? And so California is trying to build an economic Berlin Wall. And what they're saying in one of these proposals, which is unbelievable. I mean, it's absolutely, I cannot imagine this is even constitutional but I have a feeling they'll figure out a way to get away with it. They're saying that any wealth that you created up to 10 years ago, even if you've left the state, like I did, I left the state in 2011, so I'm only 9 years out. They could go back and back tax me and say, look, you earned money here in 2010 and 11, and you owe us. I could get like a surprise tax bill. I can't imagine such a thing. And one theory of that is, I heard a pundit, I can't remember who it was, but someone who was really smart, I remember, saying that one of the other things they could do is they could basically say that they own you. So if you say you went to law school in California, or you went to medical school in California, or you got an MBA, or you just got an undergrad degree or whatever, they could impute that you've earned a certain amount of income, excess income, due to that degree that you earned in California. And you literally owe the state, even if you've moved out of state, you owe the state for the excess income that degree has earned for you. I mean, this is insanity. I mean, you can't be picturing this good. Yeah.
And believe me, the Liberal Party is looking at that.
Yeah.
And they're going to be looking for, they want to, whether it's state or federal, they want to increase the taxes, right?
And what's so incredible about these two taxes, both the wealth tax and the one I just mentioned, is that they're wanting to tax people on unrealized gains. Okay, so in other words, they would recognize a gain. Their franchise tax board, the FTB in California, is a very aggressive taxing agency. They would recognize some sort of gain that you had, even if you didn't realize that gain, meaning you had property or a business that you didn't sell. You didn't get a big check. You didn't have a windfall. But they impute a tax that's due even if you didn't sell the asset. So what they're saying there is that could basically force people to sell assets to create liquidity to pay a tax. I mean, that could just tank markets. It's truly incredible. Combine that with, raising the income tax rates. They want to go up to over 16% just state income tax, not including federal. And then do away with Proposition 13, which in 1978 put a cap on what the state could charge in terms of property taxes. And look, folks, you might be thinking, listening to this, look, I don't live in California. I've never lived in California. Fine. That's not the issue. The issue is that California generally, at least historically, has kind of led the nation with a lot of trends like this. They sort of spread west, and there are copycats. Folks in New York or in Washington State or Oregon, these other left-leaning places, Illinois. They look at what they're doing and they think, "Gosh, we should do something like that."
Exactly.
And these are all slippery slopes. They're trends that become contagious. So you should be very worried about this kind of stuff. If you're in Connecticut, Massachusetts, many other places. Yeah.
Yeah, I mean, it's a slippery slope, and it's very concerning to see what's going on in California. To think November 5th, you could wake up and have wealth tax, taxing on your education, taxing triple, maybe 4 times, quadruple the property taxes, and that would easily then move to Illinois, to Northeast United States.
Yeah, the northeastern states are so left-leaning, they would adopt that stuff like this, you know.
Yeah.
Yeah, New York especially. I mean, New York is the state that is going to be extremely aggressive in looking for tax revenue because they've got huge problems, obviously.
Huge problems, yeah.
So, yeah. Julio, wrap it up for us. Give out your website.
Yeah, our website is engineeredtaxservices.com, and you can find me at Tax Reform Expert as well.
Julio, thanks for joining us.
My pleasure. Thank you so much.